Something's quietly clicking at SoFi, and if it finishes the move, we might be looking at one of the most interesting fintech breaks in years. The stock sits in the mid-20s, but a confluence of clear signals suggests it could make a serious run toward 50. In this video, you're going to see exactly what those signals are, what the risks look like, and how you should watch this move unfold. Let's ground ourselves in where SoFi stands right now. The current share price is around $25. Doubling from here isn't automatic. It requires execution, momentum, and ideally surprise. So what has to line up for that kind of move? First, the business is showing real growth. In its third quarter 2025 report, SoFi added 905,000 new members, bringing its total to about 12.6 million. That kind of traction matters because it shifts the discussion from fintech startup to platform scaling. It's not just user count, it's product adoption, membership engagement, and the growing cross-sell footprint. When you see membership plus product growth together, you often see model revisions, and with revisions come price re-ratings. Second, the next earnings print is on the calendar and it matters. The next projected release for fourth quarter 2025 is listed in one source as January 26th and another as February 1st, 2026. That sets a near-term window for a potential catalyst. If SoFi delivers strong results or guidance there, $50 suddenly looks less like speculation and more like possibility. Without that print, the stock might just trade sideways. Third, the sentiment around fintech remains hot, and SoFi sits right in the sweet spot of that narrative. It's not just a lender anymore, it's offering banking, investing, crypto access, technology platform services. That breadth gives it optionality, which markets love when the sector is firing. That said, optionality also increases expectations, and with higher expectations comes less margin for error. Fourth, on the flip side, the valuation already carries a premium for growth. From the mid-$20, a target of $50 assumes a lot of things go right. If growth slows, regulatory headwinds bite, or credit trends worsen, that same premium becomes a drag. When you're watching a move of this size, what could break the story often matters as much as what could make it. And number 5, macro conditions and regulation are playing in the background. Fintech companies are exposed to interest rate shifts, credit cycle stress, and the ever-present risk of regulation, especially when banking, investing, and crypto services intersect. For SoFi, good credit trends, stable interest rates, and regulatory clarity are tailwinds. If any of those reverse, the move becomes much harder. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. Let's take a breath now and think about what you'll want to see as you track this trade. Ahead of the next print, expect to hear commentary around member growth, product engagement metrics, revenue mix shifting toward fee-based services, and cost discipline. If those lines move positively, the jump toward $50 becomes supported. If the commentary is vague or the numbers show cracks, the stock might stall. On the chart side, watch how price behaves in the weeks leading into and after the earnings window. If you see rising volume on strong sessions and weak volume on pullbacks, that suggests accumulation. If instead you see strong red days with volume, that suggests caution is dominating. Here's the key takeaway. SoFi has many of the ingredients you'd look for in a breakout scenario: scale, catalyst calendar, sector tailwind, but the conditions are not guaranteed. The difference between a move to $50 and staying in the mid-20s will lie in execution and external environment. You now have the framework to judge which side appears more likely. If this helped you clarify the trade, tap subscribe. It ensures you don't miss when those signs hit. And one last thought, treat $50 not as a guarantee, but as a scenario. Stay alert to how the next few weeks unfold, and your edge will come from watching signals, not chasing hope.